Hello, welcome back to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching and subscribing to the channel. I greatly appreciate all the feedback and comments. Today, we're going to take a look at Walmart, a monster retail company that's trying to expand their e-retail business. And let's see if their historical financials predict what they're going to do and what we think the value might be. But before we dig into Walmart, let's go over the hallmarks for what we do in this channel and what we look for in an investment. We look for 5 key attributes: top line revenue growth, earnings growth, as we describe it as EBITDA, free cash flow growth, solid balance sheet, being less than 3 times debt, and a well-priced stock. Those 5 key attributes we use to select which investments we think are worthy of our dollar. The next thing we do is we try to establish what the intrinsic value of that business is. We compare that to the market price and we see if there's a difference and whether or not that difference will collapse over time. That's our economic return. So this is Walmart. Let's take a look at the financial information. Before we do that, let's go over a couple things here in Walmart. One, their fiscal year ends in January. So January 2020 is the 10K that I've pulled. The operating results are predominantly 2019 from February to January of 2020. So it's being kind of mid-2020 now. There's probably a 10K or 2 that are out there that's available. So definitely read those. Excuse me, 10 Qs. Those would be quarterly updates. This is the 10K as of the fiscal year end, January 2020. Go through it, a solid read. They're definitely a monster company, and it's very interesting to see if this is something that you should have in your portfolio and whether or not we think it's going to stack up to Amazon and some of the other e-commerce players. Behind me there is their revenue for 8 years. Let's take a look and see what we've got. They start 2012 with $443 billion of revenue. That's a tremendous amount of money. Then they grow that to $523 billion of revenue, just over $500 billion of Jack. That's monstrous. Kudos to them for continuing to be able to grow that beast. But the annualized growth rate is 2%. So 2%. Inflation now is what, 1% or so. So it's slightly above inflation. It technically does meet one of our categories of revenue growth, so I'll give it that. Walmart is growing, albeit slowly. Let's take a look at EBITDA and see if they will able to increase margins and what the EBITDA growth rate looks like. So as you know, EBITDA stands for earnings before interest, tax, and depreciation and amortization. It is a proxy for cash flow. It's used by a lot of industry professionals to as a quick way of smell checking cash flow and coming up with a way to value one business relative to another business. They talk EBITDA multiples. So we're going to take up operating income or earnings before interest and tax. We will add depreciation and amortization, and we'll get our EBITDA. You can see EBITDA here, and I've got a growth rate of minus 1% over the 8-year period. So top line revenue is growing at 2%. EBITDA is shrinking minus 1% annually. Just to cover the numbers really quickly, $34 billion down to $31.5 or $32 billion. So definitely shrinking. Even more recently, you say, okay, maybe that's long term, but recently there's something there. There really isn't. It grew a little bit from 30 to 32, then came back down. Reading through the 10K, it's clear that they're trying to move to an e-commerce platform. They're investing in new technology, and they're touting that their apps and the online sales are growing, which is excellent. One of the issues here is that Walmart's just so big. They have a huge presence internationally. Sam's Club is really large for them with low margins. And so while the e-business for them is growing, it's a small piece of their overall business, so it's not moving the needle just yet. So it's really going to be kind of on the faith that this growth continues to expand into the Walmart portfolio. But right now, we're not seeing it. All you're seeing is the cost side as they're investing in here. So I think that's why EBITDA is declining. Let's go through the rest of the stack up for enterprise value. Then we'll look at the multiple. Here we've got long-term debt. So this is current portion of long-term debt, capital lease obligations, any pension obligations and so forth, long-term obligations. That's gone up as well, 53 billion to 72 billion. I did not mark any excess cash. They had, I think, 9 billion of cash on hand at the end of the quarter or end of the fiscal year. But I didn't add any of it back just to say that because they're trying to invest to grow, they're going to consume that cash. It's not something they would just dividend out. So I left it zero. Market cap, again, that shares outstanding times price, 230 to 330 billion, gives you an enterprise value. That enterprise value has gone from $237 billion to $400 billion. On declining earnings, what's going on? How is enterprise value growing, earnings for EBITDA shrinking? Well, it's the market multiple. So as cash is coming into the stock market, the stock market has been growing over the last decade. Things are getting more and more richly valued. Walmart's no exception here. So you can see 8 times earnings earlier in this time period to 13 times is where it's sitting at right now and at the end of this fiscal year. So overall, that's not an expensive multiple at all to pay for such a monster company that has stability. I think the multiple is low because there's less growth, obviously, but you can see it's been historically super cheap. I mean, 8 times for a company this size is shockingly cheap. Most people will pay, 5 times for, say, a well-run pizza shop on their corner. Here to see only a couple more turns of EBITDA, and you're at the size of a Walmart typically. The larger you are, the bigger the multiple in EBITDA people pay you. It's kind of like a size premium, they call it. I think this 8 times is a really shockingly low number for such a beast that is Walmart. So back at present day, we're at the 13 times. That's much more appropriate multiple to pay for such a big company that's not growing, but it could go higher if they chose to, if they're able to grow. You could see 15 times, 18 times multiple if it became back kind of in vogue again. That multiple expansion would be a hallmark that we look for and would definitely lead to an outsized return. But we'll come back to this in a second after we do the forecast. But I just want to show you the range of multiples that you have been able to buy the stock at in the past. And then debt, we look at the debt ratio and make sure that it's not overly levered. Here, they're not at 2.3 times debt. They have taken on more debt than historically. Historically, it's been 1.5. Now they're at 2.3, but still it's below the 3 times debt mark that we look for as a hallmark of a well-capitalized, kind of less risky balance sheet. So let's review what we have. Top line revenue growth, yes, 2%. EBITDA earnings growth, no, -1%. Low debt, yes. Is it well priced? We don't know yet. We'll see how everything stacks up. But right now, it does look fairly inexpensive. Let's look at cash flow and make sure cash flow is jiving with EBITDA. Smell check the accounting. And we'll come up with a yield, and we'll see if that cash yield, what that cash yield looks like going forward. Cash flow from operations, that's my favorite financial statement. Here we've got cash flow from operations of $24 billion. It goes up to $25 billion. So again, 1% growth. That's in line, quote unquote, with the -1% that we saw in EBITDA. Basically flat. CapEx has decreased. I'd imagine they're trying to generate more free cash flow. So they're cutting back on the investments that they make. We like to look at the spread here between these two. So in a given year, they made roughly $25 billion of cash from operations selling their products. And then they had to put back into the business $10 billion to build those stores, build out their online data platform and so on and so forth. So really between this two, you're netting $15 billion of cash. You then have debt payments. The next column here is an inflow and outflow of debt, both the positive being borrowing and the negative being paying of total debt. They paid out $1 billion, mostly probably in principal, and then that leaves us with $13 billion of free cash flow. You can see the free cash flow over time has been constant or fairly constant with a -1% growth rate. just like EBITDA and just like free cash flow. Those things are lining up. You get a feel that the numbers are accurate. They're not as large as we'd like to see them in terms of a growth rate, but at least they're all trending in the right direction. Here's one thing you expect in a company like this that's having trouble deploying their free cash to grow is they're going to start buying back shares. And so you're seeing here a decline in the the shares outstanding at 3% annually over this 8-year period of time. That is their way of boosting earnings. That some people call it synthetic earnings or manufactured earnings. It's real earnings. If you own a stock a year ago, your stock has now a greater percentage claim on the earnings. So it is definitely real. There's nothing manufactured about it. But it's a way that they're increasing earnings. Free cash flow per share. It's free cash flow divided by shares outstanding. Stock price average for the month of the end of the fiscal year. I divide the two. I get a cash flow yield. So if I bought the stock today, you're roughly 4% is your cash yield. This period here, 2019. 2000 looks abnormally high at 10%, 10.5% yield. What's going on there is it looks like they borrowed a lot, $12 billion, which is spiking free cash flow because you can't, we would consider that dividendable. So it's spiking the free cash flow yield. Wasn't real, so it came back to its average around 4%. Let me get rid of these zeros. They're bothering me. All right. So now what do we do? Let's forecast free cash flow, and then we're going to forecast EBITDA. We're going to come up with what we believe is a future price for Walmart, and what the economic return looks like. So we're going to forecast two things. We're going to forecast free cash flow. We're going to forecast EBITDA. We're going to have two different ways of looking at the company, and then we're going to average the two for a kind of average target long-term price. Let's look at free cash flow. So free cash flow, I'm picking up with last year's free cash flow item I think it was nope, wrong number, sorry. 473. 473, I did not grow that. That should be grown. Sorry, let me just fix that. There you go. So that growth, yep, everything else is flowing properly. So $4.97 is the forecast for next year's free cash flow to equity. I'm just growing that now at a very low rate. You'll see when we get to EBITDA, or we already covered EBITDA, so EBITDA was flat. So all I'm doing is saying that they're going to continue to buy back shares at 3%, and that's how you're going to get the manufactured increase in free cash flow is the reduced shares outstanding that is boosting free cash flow. I then get out into 2030, $6.35 is the target. At a yield of 5% gives me a target price of $127 per share. That would be the 10-year price. EBITDA. So I'll remind you, let me go back to EBITDA here. So I'll remind you in 2019, EBITDA was $31.5 billion. And we said EBITDA was declining. So what do we do here? We can decline EBITDA continuously, just stringing it forward. We can go to zero, or we can say that there's growth. I'm going to hold it at zero for this forecast. And I'm going to drop in a little bit of growth to give us a range and see what could happen if they were able to catch on with e-commerce. But right now, what you're seeing is 0% growth out into the future because I don't know, and I'm really not willing to pay for the odds that they turn around. They've been declining for 8 years. Who's to say next year's the year they start turning around? I don't know. So what I did is I held it steady, $31.55 billion out for 10 years. I'm using the average market multiple that they received over the decade of 9.3 times. That might be a little conservative. That gives me $293 billion of value, less debt plus cash. Gives me a market cap of $242 billion. I take the shares outstanding, a little just over 2 billion shares. And I've shrunk this for the 3% buyback over the 10-year period, and I get just over 2 billion shares. Future price, 116 price target. Okay, so now you've got 116 here, and you have 127 on the cash flow. Very, very mediocre at the current price. Let's take a look, see where we are. Current price, 118. So it's 118. The two other forecasts are very, very weak, and it's mostly because they're not able to grow EBITDA. And it's what kind of growth rate do you want to assign to it in order to boost the price? Here we're not willing to venture beyond what we have already seen as proof of growth. I will do one thing. I'll drop in 3% growth to show you what happens if they do achieve 3% growth for the decade. 156 would be the number. 3% on a company that's doing $500 billion of revenue that has not been growing is going to be very difficult for them to do all of a sudden. I think the e-commerce place is great, and there's lots of opportunity in there, but right now it's a small piece of their business, and they have yet to be able to prove it. I would, well, let's see what this stacks up on the EBITDA, on the IRR. So then, if we come here, we put in the purchase price 118, we get the cash flows that we bought into earlier on the free cash flow. They don't dividend all of that out to us, but to some degree they have to reinvest it. And it's either they buy back more stock or they reinvest it, in which case it should grow. So this is the cash flows we'd receive if we own the entire business. You get $128 is the long-term price that you would cash out at, both with the sale price and the cash flow that you received that period of time. And you're looking at a 6% IRR, so very market, if not a little low. Long-term average of the stock market's been 10%. This is kind of mid-single digits of an IRR. You'd expect that for a beast that isn't growing. There's probably a lot of talk around single-digit S&P 500 return for the next decade because we are fairly richly valued. The economy is not as robust as it once was. So I think this smells right, 6%. What does it need to be to really get you an outsized return with this forecast? So $118 stock price, 6% IRR. If that comes down for some reason, they continue to print losses, the time horizon for them to really revamp e-commerce is pushed out, the stock price falls, you're not getting to double-digit IRR for a long time. So really, I think this company is dependent on showing growth for higher earnings, and then also for a market multiple expansion if you get it. For this reason, I'm going to give Walmart a meh, because I think there's more interesting opportunity out there than this company. And for the dollar that you're going to put out there, we should see a little bit more growth. So let's go through our hallmarks that we look for, the 5 key attributes. We've got top line revenue growth. Yes, 2%. It's okay. Earnings growth. No, EBITDA is negative. Cash flow was there, but it was still negative as well at minus 1%. They had to buy back shares to really boost that. Debt was low, and it was not risky, which is nice to see. And then well priced. I'd like to see it cheaper, frankly, for such a stock. So for us, I think it's a meh. We're going to wait and see what happens, or put cash out for other investments that might grow a little bit faster. All right, my name is Cameron Stewart. Thank you very much for watching Rational Investing, and have a great day. Bye-bye.